Well, welcome back, ladies and gentlemen, to Sugarbud's channel, the brand that will define quality and value for those that appreciate the finer things in life. Joining us, as always, John, the Chief Executive Officer. Welcome back, sir.
Thank you. Good to be here. Nice Friday.
And always a pleasure to have you on, man. So last time we discussed, we really broke down the company, went through your investor presentation. I implore anybody watching this to go check it out. Very intriguing stuff. But today I want to focus more on the financial side. You guys last year just released your interim, and your net revenue grew threefold to 2.1 million over 2020's 535K. Can you just kind of discuss this growth, maybe a little bit of guidance here as well?
Yeah, sure. 2021 was a big year for us. It was truly our first commercial year active in the market. So, despite the fact that the Sugarbud story has been out there for a few years now, we really started pushing out into the investor base in late 2018 as we became a company, but we didn't receive our license till late 2019. We spent most of 2020 proving out our operating model, as we discussed last time. And 2021 was the year that we really started to push into market with both our products and really our reach through distribution. So when you think about the year and you think about the revenue, the first half of the year, we really spent a lot of time and effort on product portfolio and expanding our reach to consumers. And as you know, Sugarbud is a brand all about consumer satisfaction. We don't necessarily spend the same amount of money as others do on telling people we're great. But we aspire to that moniker, and we work really hard to delight consumers each and every time. So really the first half of the year was setting that up, really delighting the consumer, establishing a strong record of traction, moving into our key markets, Alberta, BC, and Ontario. And for investors, if you really look at the trajectory that was 2021, it's really Q3, Q4 that start to show the merit of that and the benefit of that, as that onboarding and consumer adoption really started to kick in gear. And so, closing out the year, I would say we're in a great position. We've got all our regulatory licenses in place, as we talked about last time. So we've got access to 1.0, 2.0 products. We're pushing hard in the market. And, our philosophy for 2022 is actually quite simple. It's grow our base of account penetration, expand our product portfolio into markets that we've already attained, and obviously try and get a larger share within the markets that we've already attained. So we're excited about 2022. We think the run rate coming out of 2021 really sets us up for success, and we're looking forward to a strong year this year.
I appreciate those insights, and just kind of expanding a little farther into your assets liabilities, 17 million assets against 10 million liabilities with a recent cash raise. I mean, you guys did, I guess, a private debenture there, 848,000. Do you want to discuss a little bit of cash spend, how far that's going to take you, against your revenue and net losses here?
Yeah, I think if you look at the Sugarbud story and, given we're a publicly traded company, it's all there in black and white. So nowhere to really hide there. So I think our journey has been pretty obvious from the start. And one of the stories of Sugarbud from the very beginning has been that we've been incredibly efficient with our use of cash. We haven't necessarily had the access to some of the cash that many of our colleagues in Canada have. And many of the articles you see of the tens of millions of dollars that have been spent, with very little traction being achieved. Sugarbud as a company started out in 2018 with a modest recap and raise on a rights offering. And we've been fairly conservative in terms of our go public raises. We've only conducted 3, a convertible debenture in 2020, a bought deal last year, and really the recently concluded first tranche of another convertible debenture. So when you think about where we are in the market vis-a-vis our asset base, vis-a-vis our spend and burn rate, we've come an awful long way, and we're competing with the heavyweights with a very fiscally disciplined approach. That does come with trade-offs, and we don't necessarily have endless, boundless resources that we can just deploy willy-nilly. So we have to be very thoughtful, very disciplined about how we approach our resource allocation. And really right now, I think our focus is we're in a very enviable position. We're starting to see demand outpace our ability to supply, which is exciting at the same time as it is challenging. But we set that up intentionally. So as it stands right now, a lot of what we're trying to do in the capital markets is increase our capital funding and ultimately give us a clear line of sight on some future expansion coming into the back end of this year and setting us up for 2023.
Yeah, I really appreciate those insights. And just kind of taking a look at the cap structure side of things from your shares outstanding, do you want to just give some clerical insight into institutional versus retail and insider?
Yeah, I think our stock, it has an historical tale to it. We were an oil and gas company less than 4 years ago. We're a little bit unusual in terms of our shareholder base has come with that previous public company footprint. So we do have a long historical tale. We are largely a retail-driven stock. Institutions are taking more and more notice of us as we continue to scale up and get bigger. But I would say that the vast majority of our investor base is retail investors. And we think that's an exciting story. And we really enjoy having the retail base in our mix. As a publicly traded company, unlike some of our peers where founders maybe have set up the initial company, again, this is a recap of an existing pubco, a pure cannabis play now. So oil and gas is no longer part of our thought process. So our insider position isn't necessarily as great as some of our privately funded and RTO-driven counterparts. But it's still not insignificant. I would say our insider position is in and around the 10 or 11% range at this point in totality. We remain active buyers. I think investors are able to see the activity that our insiders do take when you think about SETI and other things like that in terms of public filings. So myself, I remain active. I know our directors remain active. And obviously there's a lot of others that are close to us that are interested in the story and want to continue to support it.
I appreciate that. Yeah, this is incredible. I mean, you guys seem a little bit more efficient with the capital you are using compared to when you look at some of the conglomerates like what's happened to Canopy there and just struggling to get growth off the ground. But on that note, I really want to pass the question off to the viewers. I'd love to know what you guys think about all this in that comment section below. Consider subscribing because as news comes down the wire, we'll of course continue to update you here. But on that note, stay cool, stay awesome. And as always, I look forward to catching you in the next one.